All right, buckle up, everyone, because today we're diving into a topic that might not sound super exciting at first, but trust me, it's way more fascinating than you think. UK tax implications of divorce or separation.
Yeah, taxes, right. Not exactly a party topic.
But it's crucial stuff, especially when you're dealing with the already emotionally charged process of divorce. We're going deep on a blog post from MANCO accountants titled Understanding the Tax Implications of Divorce or Separation in the UK, published just this month, February 9th, 2025.
Fresh out of press.
Exactly. And whether you're facing a split right now or just planning for the future, getting a grip on these rules can save you a whole lot of heartache and, let's be honest, cash down the line.
Absolutely. Understanding the financial side of divorce is just as important as the legal and emotional aspects.
Like you've got to have all your ducks in a row, so to speak.
Exactly.
And you might be surprised by some of the exemptions and pitfalls lurking in these tax laws. Like, did you know there's actually a time limit for transferring a house to your ex tax-free?
Yeah, there are a lot of misconceptions out there. People assume that just because you're splitting up, you're automatically exempt from certain taxes. Not always the case.
And then there's the whole question of pensions, how those get chopped up in a divorce. It's not exactly straightforward.
Nope. Pensions can be a real minefield.
So let's unpack all of that, shall we? What do you say we start with capital gains tax, or CGT as it's often called?
Sounds good. CGT is that tax you pay on the profit when you sell or even gift certain assets. Think of it like that vacation home in Spain you might have bought together.
Right, it's basically a tax on the gains you've made.
Exactly. But when it comes to divorce, things get a little more complicated because you're often shifting assets between spouses, not selling them on the open market.
Okay, so how does CGT apply when you're dividing up stuff in a divorce?
Well, the good news is, back in April 2023, the UK government made things a bit easier for divorcing couples. They extended the CGT exemption period, giving people more breathing room.
Yeah, they supersized it from 1 year to a whopping 3 years.
Right, so you have 3 years from the date of separation to transfer assets to your ex, like property, investments, even that vintage record collection, without triggering a CGT liability.
Okay, so that 3-year window is key. Can you give us a real-world example of how this works?
Sure, the blog post actually uses a really clear example with this couple, John and Sarah. Let's say they separate in April 2024. If Sarah decides to transfer her share of their house to John in, say, May 2026, they're golden. No CGT because they're still within that 3-year window.
But wait till June 2027, just a month later, and bam, CGT City.
Exactly. Those timelines are crucial.
It's like a ticking time bomb.
In a way, yes. And remember, this isn't just some random rule. It can have a huge impact on your overall financial settlement.
Now, the blog post also mentioned something about court orders potentially exempting you from CGT, even outside that 3-year window. What's the deal with that?
Ugh. Court orders, those add a whole other layer of complexity. It's really important to remember that when it comes to divorce and taxes, especially if you're dealing with significant assets or complex financial arrangements, professional advice is crucial.
So when in doubt, lawyer up.
Precisely. It's always better to be safe than sorry.
Okay, good advice. Now, speaking of property, let's move on to another tax that's closely tied to real estate. Stamp duty land tax, or SDLT for short.
Yes, SDLT. The tax you usually pay when you buy a property in the UK. But like with many things, divorce throws a bit of a wrench in the works here.
How so?
Well, here's the quirky bit. If you transfer a property because of a divorce or separation, and this is important, it has to be done under a court order, then you're off the hook for SDLT. You don't have to pay it.
So court order equals no SDLT.
You got it.
But what if it's like a voluntary transfer? Say, one spouse decides to just give their share of the house to the other. Do they still have to pay SDLT?
Yep. Even if it's to your ex, you still got to pay SDLT if it's a voluntary transfer. It's all about how the transfer is structured legally.
Okay, so court order, no SDLT, voluntary transfer, ouch, my wallet.
Pretty much. And this is another example of why having a rock-solid legal agreement during a divorce is so crucial. It's not just about dividing up the furniture. It's about protecting yourself financially and making sure you're not hit with any unexpected tax bills down the line.
Makes sense. It's like that saying, get it in writing.
Exactly.
Okay, I'm starting to see a pattern here. Divorce plus taxes equals a whole lot of potential complications.
You're catching on quickly. And we've only just scratched the surface.
All right, well, I'm ready to keep digging. What's next on our tax adventure?
Let's talk about something a bit more personal. Maintenance payments, both child maintenance and spousal maintenance. They're treated very differently by the taxman, and it's important to understand the nuances.
Okay, hit me with it. What's the difference?
So, child maintenance is pretty straightforward. It's not taxable for either parent. Makes sense, right? It's meant for the child's well-being, not to line the taxman's pockets.
Yeah, that seems fair. But spousal maintenance, that's where things get a bit more complicated, right?
Yeah, a little bit. It's like a tax tug of war. In a way, the person receiving those payments, the recipient, doesn't pay tax on that money.
Okay, that makes sense.
But the person paying the maintenance can't deduct those payments from their taxable income either. So it's not quite a win-win situation from a tax perspective.
Interesting. Like trying to strike a balance, I guess. Okay, let's tackle another big one. Pensions. We touched on these earlier, but I know they can be a major asset during a split, and splitting them up can be a bit of a minefield.
Oh, absolutely. Pensions are often one of the most valuable assets a couple has, especially if they've been together for a while.
Right, it's not just about the money you have now, it's about your future financial security.
Exactly. And the UK system allows for pensions to be split using what's called a pension sharing order. This lets you essentially carve up a pension pot and allocate portions to each spouse.
Okay, so that sounds relatively straightforward. What's the catch? You mentioned something earlier about deferred taxes.
Right, so here's the thing. The actual transfer of those pension assets between spouses, that part's tax-free. You don't get hit with a tax bill right then and there.
Okay, that's good at least.
But, and this is a big but, you will have to pay tax on that money when you eventually withdraw it from the pension down the road.
Ah, I see. So it's like a delayed tax bomb. You're just kicking the can down the road, so to speak.
In a sense, yes. It's really important to factor that deferred tax liability into your long-term financial planning.
So you're not really getting away scot-free. It's more like a tax pause.
Yeah, that's a good way to put it.
Now, are there any limitations on what types of pensions can be split?
Actually, yes. Your state pension, that one can't be split.
Okay, so the state pension is off limits.
Right. But workplace pensions, private pensions, those are fair game. They can be divided up as part of the divorce settlement. So if one spouse has, a really cushy private pension, that becomes a key point of negotiation during the divorce process.
Right, because it's essentially a valuable asset that needs to be divided fairly.
Precisely.
Okay, so we've covered CGT, SDLT, pensions. This is a lot to digest, but I think I'm starting to grasp how interconnected all these different taxes are during a divorce. It's like every decision you make has a ripple effect on your overall financial picture.
Absolutely. And we've only just scratched the surface. There's so much more to explore.
Okay, well, I'm ready to keep digging. What's next on our tax adventure?
All right, let's dive into some real-world scenarios and see how these tax rules play out for people going through a divorce.
I love this part. This is where things get real, and we can see how it all works in practice.
Right, because nobody walks down the aisle thinking, well, if this goes south, at least I'll be a pro at capital gains tax.
Okay, so let's talk about the big one. The family home. Often the most valuable asset a couple owns, and splitting it up can get really messy, both emotionally and financially.
Absolutely. There's a lot of sentimental value attached to the family home, but it's important to remember that it's also a significant financial asset that needs to be addressed during the divorce.
Right, you have to take off the rose-tinted glasses and look at it from a practical perspective.
Exactly. So let's say a couple decides to sell the house and split the proceeds. What are the tax implications?
Well, we talked about that 3-year CGT exemption, right? If they sell the house within that window, they're usually safe from CGT when transferring their share of the proceeds to each other.
That's right. But let's say they decide to sell the house after that 3-year window slams shut. What happens then?
Well, then CGT might rear its ugly head. Each spouse would be on the hook for CGT on any profit they make from selling their share of the house. And if the property value has skyrocketed since they bought it, that could be a hefty tax bill.
Exactly. And remember, that profit is calculated based on the difference between the sale price and what they originally paid for the house, minus any allowable expenses, like estate agent fees or legal costs. So keeping good records is important.
Okay, makes sense. But what if one spouse wants to keep the house and buy out the other spouse's share? How does that work tax-wise?
Well, in that case, the spouse who's buying out the other is essentially purchasing their share of the property, and that could trigger stamp duty land tax. Depending on the value of that share, it's like they're buying a portion of the house from their ex.
Ah, so SDLT pops up again. I'm starting to see how all these different taxes are intertwined, like a financial spiderweb.
You got it. And don't forget about CGT. If they're still within that 3-year separation window, they're usually fine to transfer the share without incurring CGT.
But what if they're outside that window? Is it automatic CGT?
Not necessarily. CGT only applies if the value of the share being transferred has gone up since they first bought the property. So it's crucial to keep track of all those property transactions. The original purchase price, any renovations or improvements they've made, things like that. It's all about having a clear paper trail to demonstrate how much the property is actually worth now compared to when they bought it.
So basically, it's like a financial history of the property that can prove whether or not CGT applies in a buyout situation.
Exactly. Now, let's say one spouse wants to stay in the house, but they can't afford to buy out the other right away. Maybe they're waiting for the kids to finish school, or their financial situation isn't stable enough yet. What happens then?
Yeah, that sounds tricky. Do they just have to wait it out?
Well, one option is to delay selling the house, but there can be downsides to this. Well, if the property keeps increasing in value, which is likely in many areas of the UK, that means the eventual profit when they do sell, and therefore the potential CGT liability, will also be higher. So, delaying the sale might seem like a good idea in the short term, but it could come back to bite you later on.
Okay, so it's a bit of a gamble.
Yeah, it's all about weighing the pros and cons and making the best decision for your specific situation.
Now, what about the spouse who's moved out of the house? Are they still considered a part owner even if they're not living there?
It really depends on the legal agreement they reach during the divorce. They can set things up so that one spouse officially owns the house, but the other still retains a financial interest in it. So even though they've moved out, they're still entitled to a portion of the proceeds when the property is eventually sold. And that share would be subject to those same CGT rules we talked about earlier.
So even if you physically moved on, the financial ties to the property can linger because of those tax implications. It's almost like a financial echo of the relationship.
That's a great way to put it. And it underscores how important it is to think carefully about the long-term financial consequences of your decisions during the divorce process.
Okay, so we've tackled the family home, and it's clear that even something seemingly simple like selling a house can get way more complicated when divorce and taxes collide. What about pensions? We talked about those earlier, but I know they can be a bit of a minefield to split up during divorce.
They certainly can be. We established that you can split pensions using a pension sharing order, but how does that actually work in practice? How do you divide something that's basically a promise of future income?
Yeah, it's not like splitting up the furniture or dividing a bank account. It's much more abstract.
You're right, it's not as straightforward as divvying up physical assets. But there are different approaches to splitting pensions. Sometimes it's a simple 50-50 split of the pension pot. That often feels fairest if the couple has been together a long time and both contributed equally to the household finances.
That makes sense. But what if one spouse earns significantly more than the other, or if they haven't been together long enough to have accumulated equal pensions? You wouldn't necessarily want a straight 50-50 split in those cases.
Exactly. In those situations, you can get into percentage splits based on what feels fair and equitable. It could be 60-40, 70-30, or whatever they agree on. It allows for more flexibility and takes into account factors like the length of the marriage, each person's earning potential, and their overall financial needs.
So it's about customizing the split to fit their unique situation.
Precisely. There's no one-size-fits-all solution when it comes to pensions. It's all about finding a solution that works for both parties and ensures they're both financially secure in the long run.
Okay, but how do you actually move those pension assets from one person to the other? Do you just write a check?
It's not that simple, unfortunately.
Yeah.
It usually involves setting up a brand new pension scheme for the spouse who's receiving a portion of the assets. That new pension scheme is then funded with the agreed-upon amount from the original pension pot.
So it's like creating a separate, independent pension account that's funded with a chunk of the original pension.
You got it. And that new pension scheme is then managed separately from the original one, so each spouse has their own individual pension moving forward.
Now, we talked earlier about the deferred tax liability when you eventually withdraw money from a pension. But are there any immediate tax consequences when you're splitting the pension itself?
Thankfully, no. The transfer of assets from one pension scheme to another during a divorce is generally tax-free at the time of the transfer. You only pay tax when you start taking money out of the pension, usually in retirement.
Okay, that's good to know. Are there any scenarios where the tax rules around pension splitting could get a bit more complex? Like, are there different types of pensions that might make things trickier?
You're asking all the right questions. You're thinking like a tax pro now. And yes, some pensions are definitely trickier to split than others. For instance, if someone has a defined benefit pension scheme, those are more complex than splitting a defined contribution scheme.
Okay, break that down for me. What's the difference?
So, a defined benefit pension scheme guarantees a certain level of income in retirement based on a formula that takes into account things like your salary and length of service. Splitting that kind of pension can require actuarial calculations and can be quite complex. On the other hand, a defined contribution scheme is where the value of the pension is tied directly to the contributions that have been made. So splitting that is a bit more straightforward. You're essentially just dividing up the pot of money that's been accumulated.
So it's like trying to split a pie versus splitting the recipe for the pie.
That's a great analogy.
Yep.
You're getting the hang of this. So if you're dealing with those more complex defined benefit pension schemes, it's even more crucial to seek expert advice from a financial advisor or pension specialist who can help you navigate those complexities.
Okay, noted. When in doubt, get the experts involved. Now, ready to tackle another emotionally charged aspect of divorce: inheritances.
Hit me with it. We've covered a lot of ground, but inheritances are definitely an important piece of the puzzle.
We touched on this earlier, but I want to dig a bit deeper. Remember how we discussed that ex-spouses don't get the same inheritance tax breaks as married couples?
Right, so spouses' inheritances are completely exempt from IHT, but ex-spouses don't get that same benefit.
Exactly. So let's say someone is concerned about minimizing the potential inheritance tax their ex-spouse might face if they were to inherit something from them. What can they do to protect their ex from a big tax bill down the road?
It's a thoughtful question, and it shows you're really thinking about the long-term implications of these financial decisions. You don't want to leave your ex, even if things ended amicably, saddled with a massive tax bill. So in this scenario, estate planning becomes crucial.
Okay, so what kind of estate planning strategies can help in this situation?
One powerful tool is setting up trusts. Imagine it like this. You create a trust that holds the inheritance for the benefit of your ex-spouse and any children. That inheritance is then no longer considered part of your estate for inheritance tax purposes. It's like creating a separate little vault for those assets.
So it's a way to shield the money from inheritance tax. That's clever. But trusts sound complicated.
They can be. There are lots of different types of trusts, each with their own rules and tax implications. Getting solid legal and financial advice is crucial when you're dealing with trusts. It's not something you want to try to DIY.
Okay, so trusts can be a good strategy for protecting an inheritance from IHT, but professional advice is a must. Got it. Now, what happens when a couple gets divorced and there's a family business involved? That just seems like a recipe for complications.
You're not wrong. Valuing a business for divorce purposes is notoriously tricky, and both spouses can face tax consequences, whether they were actively involved in running the business or not.
Right, because we talked earlier about how a business is considered a marital asset, even if only one spouse is involved in the day-to-day operations.
Exactly. So even if one spouse hasn't been actively running the business, they could still be entitled to a portion of its value as part of the divorce settlement. And that's where things can get complicated from a tax perspective.
Okay, but valuing a business seems way harder than valuing a house or a car. There's no Kelly Blue Book for businesses, right? How do you even determine what a business is worth?
You're right. It's not as simple as looking up the value in a guide. You often need to bring in a professional valuator to determine the fair market value of the business. They'll take into account things like the business's assets, liabilities, how much money it's making, its profitability, and its potential for future growth. It's a much deeper dive than just assessing the value of a physical asset.
So once you have that magic number for the business's worth, how does that impact the tax situation for the spouses during the divorce?
Well, if one spouse receives part of the business in the divorce settlement and the value of that portion has gone up since the business was started, they could be hit with capital gains tax.
Wait, so even if they didn't actually build the business themselves, they might still have to pay CGT on the increase in its value? That seems a bit rough.
It can feel that way. And that's why it's so important to understand the tax implications of any settlement agreement before you sign on the dotted line. You don't want to end up with a surprise tax bill on top of everything else you're dealing with during a divorce.
Right, it's like this hidden cost of divorce that people don't always think about until it's too late.
Exactly. It adds a whole other layer of complexity to an already complex process. That's why, in these situations, seeking specialized advice from professionals who understand both divorce law and business taxation is crucial.
Yeah.
You need someone who speaks both languages fluently.
Okay, so we've covered property, pensions, inheritances, and even businesses. It's clear that divorce can trigger this whole domino effect of tax consequences. Is there anything else we should be aware of? Are there any other hidden tax traps lurking out there?
One more crucial area that's often overlooked: tax credits and benefits. These can have a significant impact on your financial well-being after a divorce, so it's important to understand how they work and how your eligibility might change.
Oh, right. Things like child tax credits, universal credit, even the personal allowance. Those can all shift depending on your marital status, your income, and your living arrangements, right?
Exactly. The UK has a complex system of social welfare programs and tax credits designed to support individuals and families, but your circumstances can change drastically after a divorce, and that can affect your eligibility for these programs. Let's take child tax credits, for example. If you are claiming them as a couple, after the split, you might not qualify for the same level of support as a single parent.
And what about universal credit? That's for people on low incomes or who are unemployed, right?
Oh.
So I imagine that could be a lifeline for someone going through a divorce, especially if they're facing financial hardship.
Absolutely. Universal credit is designed to provide a safety net for those who need it most, and that can include people going through a divorce who are facing financial strain. But, just like with child tax credits, your eligibility for universal credit is based on your marital status, your income, and your living arrangements. So if those factors change because of the divorce, you need to update your information with the Department for Work and Pensions to make sure you're receiving the right amount of support.
So it's like this financial safety net that needs to be adjusted after a divorce to make sure you're still covered.
You got it. It's crucial to stay on top of those changes and make sure you're receiving all the support you're entitled to. And then there's the personal allowance, which is the amount of income you can earn each year before paying income tax. That can be affected by your marital status, too. Remember the marriage allowance.
Yeah, that's where you can transfer part of your personal allowance to your spouse if they earn less than you.
Right. Well, say goodbye to that little perk after divorce. You'll each have your own individual personal allowance, and you won't be able to share it anymore.
It's just another financial hit to deal with. It's like divorce comes with this whole hidden price tag of potential financial downsides.
That's a good way to put it. It's important to be aware of those potential costs so you can plan accordingly and make informed decisions. Divorce sends ripples throughout your financial life, and it's best to be prepared for those changes.
Okay, so we've talked a lot about the potential tax pitfalls and financial challenges that can arise during a divorce. But divorce can also be a time of rediscovering your own financial identity and taking control of your future. How can people going through this process start to rebuild and create a secure financial future for themselves? It seems pretty overwhelming.
It can definitely feel overwhelming, especially when you're already dealing with so much emotional turmoil. But it's important to remember that you're not starting from scratch. You have experience, knowledge, and the ability to learn and adapt.
Hmm.
The key is to take things one step at a time.
Okay, that makes sense. So where do you even begin? What's the first step on this path to financial independence after divorce?
I'd say the most important thing is to take stock of where you stand financially. Understand your income, your expenses, your assets, and any debts you have. It's like creating a financial map of your current situation.
So it's all about clarity and understanding your starting point before you can move forward.
Exactly. Once you have that clear picture, you can start setting achievable financial goals and crafting a plan to reach them. It's about taking ownership of your financial well-being and making choices that align with your values and aspirations.
I like that. It's about taking control and designing a future that reflects your new life and your new priorities. But what are some specific areas people should focus on when it comes to financial planning after a divorce? Are there any key areas you'd recommend prioritizing?
One of the most crucial things is to build an emergency fund.
Why is that especially important after a divorce?
Well, because divorce often brings a lot of financial uncertainty. Unexpected costs might crop up, your income might change, your expenses might fluctuate. An emergency fund is like a financial cushion that can help you weather those storms without going into debt. It provides a sense of security and peace of mind during a time that can feel very unstable.
It's like that saying, hope for the best, prepare for the worst. You're hoping for smooth sailing, but you're ready for anything life throws your way.
Exactly. Once you have that safety net in place, you can start looking at longer-term financial goals, like saving for retirement or buying a new place. But that emergency fund is your foundation, and it's important to build it up as quickly as possible.
Okay, so emergency fund.
Okay.
What about debt? Divorce can lead to increased debt, especially with legal fees and all that. How do you tackle that debt monster?
Managing debt is absolutely essential for regaining financial stability after a divorce. The first step is to create a realistic budget and track your spending. You'll quickly see where your money is going and identify areas where you can cut back and free up more cash to throw at those bets.
Yeah, budgeting. It's like that boring but essential chore that we all try to avoid. But I guess there's no escaping it, especially when you're trying to get your finances in order.
You got it. Budgeting is your financial roadmap. It helps you stay on track and make conscious choices about where your money goes. And once you have that budget in place, you can explore different debt repayment strategies. Have you heard of the snowball method or the avalanche method?
Vaguely, but refresh my memory. How do those work?
The snowball method is all about building momentum. You focus on paying off your smallest debts first, regardless of the interest rate. It's like a psychological trick. It gives you a sense of accomplishment as you see those debts disappear, and that keeps you motivated to keep going.
So it's like a motivational boost to keep you moving forward.
Right. The avalanche method is more strategic. You prioritize the debts with the highest interest rates, even if they're bigger. This approach saves you more money on interest in the long run.
So snowball for motivation, avalanche for efficiency. I like it.
Exactly. It's about finding what works best for you and your personality. And remember, if you're feeling overwhelmed by debt, don't be afraid to seek professional help from a financial advisor. They can help you create a personalized debt management plan and guide you through the process.
All right, one last thing I want to touch on before we move on to the final part of our deep dive.
Right.
Rebuilding credit after a divorce. Your credit score can take a hit, especially if you had joint accounts with your ex-spouse, and that can make it hard to do things like get loans, rent an apartment, or even get a credit card.
You're right. A good credit score is essential these days, and rebuilding it after a divorce can feel like an uphill battle. But it's definitely doable with the right approach.
Okay, so where do you even begin?
The first step is to check your credit report from all three major credit bureaus. You're entitled to a free copy from each of them. This gives you a clear picture of your current credit situation and helps you identify any errors or inaccuracies.
Okay, so get that report and make sure everything is accurate. But what if there are errors? What can you do?
You have the right to dispute those errors with the credit bureaus, and they're obligated to investigate and fix any mistakes. So don't be afraid to stand up for yourself and make sure your credit report reflects your true financial situation.
Good to know. You have rights. So what else can people do to rebuild their credit after a divorce?
The most important thing is to establish a new pattern of responsible financial behavior. That means consistently paying all your bills on time, from your rent or mortgage to your utilities and any existing debts you have. This shows lenders that you're reliable and can be trusted to manage your finances responsibly.
It's like building a new track record of financial trustworthiness.
Exactly. Another good option is to consider a secured credit card. These cards require a security deposit as collateral, but they're a great way to rebuild credit if you've had problems in the past. They show lenders that you're serious about improving your credit history.
It's like showing them you're willing to put your money where your mouth is, so to speak.
Right. And if you have a close friend or family member with excellent credit, you could ask them to add you as an authorized user on their credit card. This can give your credit score a little boost, as their positive credit history will be reflected on your report as well.
So it's like borrowing a bit of their creditworthiness.
Yeah,
Clever.
exactly. But remember, you're still responsible for any charges you make on their card, so make sure you communicate clearly and establish ground rules to avoid any misunderstandings or financial conflicts.
Right. You don't want to jeopardize that good relationship by racking up debt on their card. Okay, so we've talked about property, pensions, tax credits, debt management, and credit rebuilding. It's clear that the financial side of divorce is a marathon, not a sprint. It takes time, effort, and a lot of careful planning.
It absolutely does. But remember, you don't have to run this marathon alone. There are resources available to help you, professionals who can guide you, and strategies you can use to regain control of your finances and create a secure future for yourself.
Okay, before we move on to the final part of our deep dive, I want to bring up something we haven't explicitly addressed: the emotional side of all these financial decisions. Divorce is tough emotionally, And I imagine those feelings can sometimes cloud our judgment when it comes to money matters.
You're absolutely right. We've been diving deep into the technicalities and the practical aspects of divorce and taxes, but it's crucial to acknowledge that emotional undercurrent that runs through all of these financial choices. Divorce is an emotional roller coaster, and it's perfectly normal for those emotions to spill over into the financial decision-making process.
It makes sense. It's not just numbers on a spreadsheet. It's about people's lives, their hopes and fears, their sense of security. It's all tied up together.
Exactly. And when those emotions are running high, it can be really tough to think clearly and rationally about money, especially when you're already dealing with so much change and uncertainty.
So how can people going through a divorce stay grounded and make sound financial choices even when they're feeling overwhelmed emotionally? It seems like a tough balancing act.
It is, but I think the first step is to acknowledge those emotions, to give yourself permission to feel them. Don't try to bury them or pretend they're not there.
Right.
Allow yourself to grieve, to feel angry, confused, whatever comes up for you, it's all part of the process.
And welcome back to the final part of our deep dive into the UK tax implications of divorce and separation. We've covered a lot of ground, from CGT and pensions to the emotional side of these financial decisions.
It's been quite the journey, a lot to unpack there.
It really has, but I think we've saved the best for last. In this final part, I want to focus on something that can be truly empowering for people going through a divorce, and that's taking control of your financial future.
Absolutely. Divorce, while challenging, can also be a catalyst for, financial growth and self-discovery. It's a chance to redefine your relationship with money.
Exactly. So let's talk about financial independence after divorce. What does that mean? What does that look like?
Well, I think it's about, taking ownership of your financial well-being and creating a life that reflects your values and aspirations. You're no longer part of a couple, so you get to define what financial success means to you as an individual.
Okay, that makes sense. So for someone who's, starting this new chapter, what are some practical steps they can take to embrace that financial independence? Where do they even begin?
I always say knowledge is power, so I'd start by educating yourself about personal finance. Read books, take courses, listen to podcasts like this one, explore reputable websites, even talk to financial advisors if you can. There are so many resources out there.
So it's like giving yourself a financial crash course, becoming more financially literate.
Exactly. The goal is to feel more confident and empowered to manage your own money and make informed decisions that are right for you.
It's like building that financial confidence muscle. The more you know, the less intimidating it all seems.
Precisely. And don't be afraid to ask questions. There's no shame in admitting you don't know something. The more you learn, the better equipped you'll be to handle your finances.
All right, so knowledge is step one. What comes next?
Well, once you have a better understanding of the basics, it's time to set some financial goals. What do you want this next chapter of your life to look like? Maybe you want to buy a place of your own, maybe start a business, travel the world, or just create a more secure financial future for yourself and your kids. Whatever it is, define those goals and start working towards them.
It's like creating a financial roadmap for this new journey you're on.
Exactly. And once you have those goals in place, you can start building a plan to achieve them. It might feel overwhelming at first, but remember, you don't have to do it all at once. Just take it one step at a time.
Now, one thing that can be really intimidating for people going through a divorce is the whole legal process. It's often shrouded in mystery and complex legal jargon, and it can be tough to know where to turn for help.
You're right, the legal side of things can be daunting. But remember, you don't have to navigate it alone. A solicitor who specializes in family law can be your guide through this process.
Yeah, they can explain your rights, help you understand the legal terminology, and advocate for your best interests.
Exactly. Think of them as your legal translator and advocate. A good solicitor can also connect you with other professionals who can provide valuable support, like financial advisors or tax accountants.
Right, so it's about building a team of experts to help you through this.
Precisely. And there's no shame in seeking help. It's a sign of strength, not weakness, to acknowledge when you need support and guidance.
And remember, you're not alone in this. There are support networks, online communities, and resources available to help you every step of the way.
Absolutely. Don't be afraid to reach out and connect with others who understand what you're going through. Sometimes just knowing you're not alone can make all the difference.
Now, remember that thought-provoking question I asked earlier? If you could wave a magic wand and change one thing about how finances are handled during divorce, what would it be?
Ooh, that's a good one. Hmm. After all our conversations and delving into these complexities, what really strikes me is how intimidating and inaccessible the whole process can be for many people.
I see what you mean. It can feel like you need a law degree and a finance degree just to understand what's going on.
Exactly. We talk about seeking professional advice, but realistically, not everyone can afford a solicitor, a financial advisor, and a tax accountant. Those costs add up quickly, and for many people, especially those who are already struggling financially because of the divorce, those costs are just out of reach.
So there's this financial barrier to accessing the help you need.
Sadly, yes. And that's something I'd love to see change. We need more accessible resources. Free or low-cost legal clinics, readily available financial counseling, and online tools that provide clear, user-friendly information about divorce and finances. We need to empower people with knowledge and resources, regardless of their income.
Right. Knowledge is power, and it should be available to everyone. It's about leveling the playing field.
Exactly. And we need to start these conversations earlier, even before marriage. Encourage couples to have open and honest conversations about money, and consider things like prenuptial agreements to set clear financial expectations from the outset.
Yeah, that could prevent a lot of heartache and financial surprises down the road.
Absolutely. So to answer your question, if I had that magic wand, I'd make the whole financial side of divorce more transparent, more accessible, less intimidating, and more supportive, regardless of your income or your financial situation.
I love that. It's about creating a fairer and more compassionate system that helps people navigate this challenging transition and emerge stronger and more financially secure on the other side.
Couldn't have said it better myself.
Well, I think that's the perfect note to wrap up our deep dive. We've explored the tax implications, the emotional challenges, the legal maze, and the incredible potential for financial growth and independence after divorce.
It's been a pleasure sharing these insights and exploring these complexities with you and our listeners.
And to our listeners, thank you so much for joining us on this deep dive. We know this isn't always the easiest topic to digest, but remember, knowledge is power, and you have the strength and resilience to create a fulfilling and financially secure life for yourself, no matter what challenges you face.
You've got this.
And remember, we're always here to help you navigate the exciting and sometimes confusing world of personal finance. Until next time, keep learning, keep growing, and keep diving deep.